Good evening. Welcome to tonight's futures update, Simpler Futures. Today's Wednesday, March the 9th, and that puts us one day in front of tomorrow, Thursday, being rollover for the U.S. equity index futures products, S&P, NASDAQ, Dow, Russell, etc. So that means that as of tomorrow, it's officially on the bell, on the opening bell tomorrow at 8:30 Chicago time. The equity index futures products are going to start to roll from what is their current active front month to what is soon to become their new active front month, where the March contracts will start the rollover, not expiration, but rollover process into the June contracts, wherein then next week on Friday expiration, the March contracts will expire and roll off the board. Okay. So today, here at end of day, the S&Ps have rallied 100 points. They rallied more than that. They gave up 25 or something into the close. At one point, that was up 130. But we've rallied today to back to yesterday's high, holding yesterday's low back to yesterday's high. That in and of itself is, well, it's a equal opposite bullish formation that is only a setup. It needs a trigger to actually trigger continuation. Trigger is the breach sooner than later, ideally tomorrow, but could be 2 days out. Breach the high of that formation, which would be to breach either yesterday or today's high, the highest high of that. So that would be to breach today's high because it was higher than yesterday's high. We're closing at yesterday's high, but today's high was a little higher. So if tomorrow the market happens to roll over and first trade through yesterday's low and today's low, it's about the same, then that would negate the equal and opposite bullish formation, which is actually a bullish formation for right now that needs to actually trigger in order to become a trade. If that were to happen, your target would be 43.43 on a March basis, and maybe on a June, but I would still be using March for targets like that. All right, so that's step one. That's one. Now, additionally, notice by the thing that I've got up here, notice the fact that the new incoming June contract, ESM, is priced at 42.65, whereas the March is at 74. All right, there's a 9-point differential between those two contracts. There's a 9-point spread between the new, soon-to-be incoming front month and the soon-to-be outgoing expiring March. Notice also that the new contract, June, is priced lower than the March. So that's a rollover gap, and that will present a trading opportunity on the bell tomorrow morning. Here's how that works. In the upper two panes up here, you'll notice in the left, I've got continuous ticker ES, which is March. And on the right, I've got it designated to June, ESM. Notice the price 67 over here versus 77 on the left. Here's how you would do the trade. Tomorrow morning on the bell, let's just imagine for a minute that it is exactly 8:30 Chicago time right now. And this is your opening price right here. The trade works like this. You would use, in my opinion, you use the new contract, the June, as your trade vehicle. You use the old March as your target. The trade is to fill the gap. The trade is always the same. The new contract trades to the old to fill the gap. So right now it's 8:30. Ding, ding, ding. It's the bell. 67 in the June, 77 in the March. You let it open, tick down. I would suggest 3 to 4 points. You buy the June contract, give it about the same in risk, 3 or 4 points. So it ticks down about 3 or 4 points. You're buying it. You got about 3 or 4 point risk. And your target is in the June contract. So it opened at 67. You're going to reach down here and try to buy it at like 63. Your target is that opening price of the March contract, 77. So your trade is 63. You're trading June. You trade 63 long, target 77. Now, let me be clear. I'm asking that you imagine this is the opening right now. I don't know what the price is going to be on the opening. If the price on the opening is 60, well, then you would let it trade down to about 56 and buy it and target, it'd be about 13 points higher in exchange for that 3 or 4 point, risk. That's the way the rollover trade works. I mean, for instance, we've got a rollover gap right now in the bonds. The June contract is to target 52.08 in order to fill its rollover gap. There's rollover gaps all over the place for all these different products as they roll from one existing current, what's called front month to its going off the board and making room for a new incoming contract to then become the current front month, right? So tomorrow is rollover. And by the way, you can do this same thing in all the other products. You just need to go and figure out what's the rollover gap. If you wanted to do it in the Russell or something instead, you go RTY and you'd look and see it's 15 versus 17. That's not really worth it. That's only a 2-point rollover gap, so you probably would not want to do that. NASDAQ, let's see, what's NASDAQ got? 33, 34, not worth your time. It's just, that's a waste of time. You wouldn't want to do that. And YM has no. It's only a 10-point gap. You can get 10 points in the Dow at any time of day just because it's wiggling. So the rollover trade is, the roll is on for tomorrow. It's not the expiration. It's not expiration now. Expiration's the Friday after, which is that triple witching Friday. This is just a rollover. I will also take a minute, even though this is going over in time. We like for these videos to be a little shorter, but I will also mention that tomorrow will be a very confusing day. It's Rollover Thursday. Half the day, you'll be wondering, am I looking at a March or a June quote? And for the S&Ps, that's a big deal because it's like a 9-point differential between the two. The volume is really wacky on rollover because you've got maybe a negative delta on the March but positive on the June. Well, what do you do with that? It's like, well, they're selling out of the March in order to buy the June. The March may look a little bearish and then the June looks bullish, and it's all just about the roll. There's delta hedging and all kinds of spreads that have to come in, and it's a confusing day, honestly. It's one that I would encourage you to either take it really easy or maybe even consider taking off, kind of after you do the rollover trade, maybe consider taking the rest of the day and just watch and see how things play out. Hope this helps. It's the rollover. We get opportunity. We get once a quarter. And if you want to watch this one and not participate, just learn from it. Just know that there'll be another one next quarter. It happens 4 times a year. There's no real hurry to maybe start something that you're just hearing about for the first time, for instance. So Good trade, nice evening, enjoyed it, and look forward to being with you at the next update. Till then.
Without simpler trading, I could not have financial independence.
This is one of the best investments I ever made in my life.
It's helping me find consistency.
It's one of the things that won me